Figuring out how to invest your money, especially in times like this, can be a real challenge. Although there's no shortage of information on investing, too much information can also be overwhelming. 2020 was anything but a smooth ride for investors. The economic fallout of the global health situation led stocks to plummet and millions of people lost their jobs. Although the market rallied through the year and there were uneven gains, some stocks in industries hit hard by the situation suffered major losses that year. In this video, we're going to talk about the many ways people should invest in 2021. But before we get into the videos, don't forget to leave a like and subscribe to the channel with notifications turned on so you don't miss any of the new videos we post. The first step is to determine how much help you want. There are many ways you can choose to receive help if you want to invest your money. Some people say they are too busy and they don't have the time to learn how to invest, so they end up entrusting their money to a financial advisor or to a mutual fund manager. Both options will see you being charged fees based on a percentage of your investment in return for the financial advisor's or fund manager's service. If you would like a slightly lesser fee, you can always opt to use a robo-advisor. As can be inferred from the name, your money will be managed robotically through a computer algorithm. This has gained a lot of popularity over the last few years because it is more economical than paying for the services of a financial advisor. However, it does not pick investments based on the modern portfolio theory or MPT. This limits your investments and doesn't allow them to produce astounding returns or even beat the market. Your other option is to learn stuff so you can manage your investments on your own. The next step is to figure out how much you want to invest. The dollar amount you invest is up to you, and the figures vary from one person to another. So, how much of your money should be invested? It really doesn't matter how much or how little money you have. If you're investing in your 20s, you can invest as little as a few $1,000s annually, and you are on track to preparing for your retirement. An excellent practice to keep in mind is to set aside a portion of your paycheck for investment. You can take out what you need to live on, such as food and housing expenses first. Establishing such a habit early will allow you to have more money to invest, and you'll be ready to invest once the time is right. Should you be investing every month? Although some people preach that making a monthly investment is key, this isn't always beneficial. The important lesson which everyone must learn is to be patient when investing. The right time to invest in the market is not any time. It is when the companies you have a desire to invest in reach a price that allows you to purchase them at an incredible discount. This doesn't happen every month, as you may have already guessed, so you should hold on to your money and wait until the time is right. A lot of people are asking if it's better to save money or to invest it. To save or to invest? What should it be? While you are waiting for the right price, you should be patient, and you can save your money during the interval. However, you shouldn't leave your money in a savings account for a long time because this will only hurt you. While in the bank, your money is losing value thanks to mediocre interest rates and inflation. Investing your savings wisely will help you grow your wealth over time. Dedicate your money to investing instead of saving. However, it is always a good idea to set some money aside in an account should there be emergencies. Once you have an amount for your emergency account, which you are comfortable with, you can put what's left into your investment. Do you really need a lot of money if you want to invest in stocks? You don't need a lot of money if you want to invest in stocks. As a matter of fact, you can invest even if you have little money. In fact, it's recommended for noobs to start investing small amounts and go from there. Investing small allows you to practice. It also gives you the opportunity to learn your true risk tolerance and get comfortable with your strategy. Small amounts of money can be turned into fortunes over time with the right investment. This can be attributed to compound interest. For example, if you have $500 to invest, there are numerous small investment ideas that you can check. How do you make money by investing? The key to making money is investing for the long term. So, what's the difference between long-term and short-term investments? There's a big difference between short-term and long-term investors. Short-term investors make moolah trading in and out of stocks over a short period. There's certainly money to be made doing this, but this will put you at Lady Luck's grace. You can easily lose money as much as you can make profits. Some people might succeed in short-term investing, but it isn't something that benefits most people. Investing isn't a get-rich-quick scheme. It is a way for you to grow your wealth over the long term. When you invest for the long term, you minimize risks and avoid the crushing effects chance of price drops and short-term volatility. However, it takes commitment because you have to let your money compound in the stock market for a decade at least. It may not sound that glamorous, but it's one of the most effective ways of growing rich. There are many places where you can invest your money. So, where should you put it? It's now time to decide where to put your money for the long term. There are many options out there. The stock market is the most common place where people put their money. Purchasing a stock lets you own a small portion of the company, and when that company profits, you also make money in dividends based on the number of shares you own. When the company's value grows over time, so does the price of your shares. You will be able to sell them at a later date for profits. Another option is index investing. Index investing is another way of investing in the stock market. However, instead of purchasing stock in an individual company, you buy stock in a stock market index. This tracks a number of large companies in the stock market. One of the lesser understood types of investment is the investment bond. How do they work? When you buy a bond, you are, in a sense, loaning money to a company or the government. The company or government selling the bond will then pay you interest on the loan over the period of the bond's life cycle. Although considered less risky than stocks, the potential of returns for bonds is lower. If you don't want to buy single stocks, you can invest in mutual funds. Similar to index funds, mutual funds let you buy a basket of stocks in a single purchase. However, unlike index funds, mutual funds are typically chosen and managed by a mutual fund manager. These managers charge a percentage-based fee when you invest. This fee makes it a challenge for investors to beat the market when they invest in mutual funds. Another option is physical commodities. These are things that you physically own, such as gold and silver, and they serve as a safeguard against difficult economic times because they will always hold their value. Lastly, there are savings accounts. This is what most people are familiar with. However, you shouldn't really think of them as a way to invest your money. Putting your money into a savings account and letting it collect interest has the least risk, but it's also thought of as the worst way to invest money. Low risk usually means low returns. There is negligible risk when you put your money in a savings account because there are also little to no returns. Putting your money in a savings account is only hurting you because you won't make enough interest to even cover the cost of inflation. What investing mistakes should you recognize and avoid? One of the worst mistakes you can make is investing money you need in the near term. The market can easily drop and has even crashed from time to time. When this happened, it wiped out huge portions of investors' cash. Because of this, you should never invest money which you expect to spend in the next few years. This way, should the market go down, your immediate lifestyle will be spared from any effects. This will also enable you to stay invested when you have losses as a result of an uncooperative market. Another investing mistake is paying too much attention to stocks' past performance. There's a reason why you always see disclaimers saying past performance is not indication of future results. What happened in the past won't dictate what's going to happen in the future. The only problem with the future is that it hasn't happened yet and it may not unfold exactly as you hoped. A company whose shares have done well in the past may perform dismally in the future, and a company that's performed dismally in the past may see its prices soaring in the future. Failing to diversify can spell the difference between failure and success. Even if you studied the market really well and the company you have invested in is very solid, things can go wrong in the market really fast. Don't be all in on a single company because if it fails, all your money will burn. You need to diversify because when you do so, you won't be devastated if one of your companies happens to fail. What do you want to invest your money on? Let us know in the comments section. We'll see you in the next video and stay safe.